Hello, everyone. On behalf of the Counselors of Real Estate, it is a pleasure to welcome you to this session of What's Next for Real Estate and the Life Experience, Real Estate and the Ticking Debt Bomb. Thank you for joining us. I'm Bill McCarthy, CRE, Global Chair of the Counselors of Real Estate and President of McCarthy & Company in Burnaby, British Columbia, Canada. The Counselors of Real Estate is a distinguished international group of accomplished advisors solving the world's real estate challenges. Experienced, innovative, and credentialed problem solvers, counselors reside in 21 countries, practice in many more, and offer expertise in 60 real estate disciplines across all asset classes. Each has earned the prestigious CRE designation. I'd like to recognize our What's Next webinar series sponsors, Altus Group, Busak Real Estate, Equus Capital Partners, Avison Young, and Colliers International. Thank you sincerely for your support. Before we begin, I'm pleased to offer you a free subscription to the Counselor's peer-reviewed professional journal, Real Estate Issues. If you don't already subscribe, please visit cre.org/REI. You're encouraged to utilize the Q&A feature should you wish to submit a question to our panelists. Your participation is welcomed, and we'll answer as many questions as time allows. Just over a month ago, during our first of the year webinar and virtual events, the Counselors' esteemed Economic Advisory Council highlighted and debated the prospects of a recession, the jobs market, where interest rates might land, and the impact of these forces on real estate markets. Today, we're focused again on the trajectory of interest rates, capital flows, and more specifically, the outlook of real estate debt markets in 2023 across all lender types. I'm privileged to introduce today's moderator, Kerrianne Lappin, CRE, Managing Director of Bentall Green Oak in Greater Boston. Kerrianne focuses on commercial real estate debt investments, primarily in the US, and Kerrianne is the perfect choice for today's session. Welcome, Kerrianne.
Thank you, Bill, and thank you everyone for joining us. As you entered the call, we put up a poll just around where you felt that interest rates would be by the end of the year versus where they are today. So interestingly, the majority of participants on the survey, 48%, indicated that interest rates would be higher than where we're seeing them today. 20% felt that they would be lower, and 27% thought they would be about the same by the end of the year. And admittedly, 5% said, I have no idea. So hopefully we'll be able to give you some things to think about in order to answer that question. I would describe that the market is feeling that there is some cautious optimism occurring where interest rates could potentially come down by the end of the year. However, I think as we get into the discussion with our panelists, we'll see whether there really seems to be much behind that to support that conclusion. So I'm happy to welcome today our two panelists. So we have with us Brian Bailey. He's a real estate subject matter expert with the Atlanta Federal Reserve Bank. And also we have Dennis Schoenmaker, who is with CBRE Econometric Advisors. He's a principal economist there based in London. So thank you all. We're going to connect this with the comments that you heard at the last CRE webinar, and then hopefully really dive deep into some of the challenges that the debt markets are experiencing today, and leave some time for some Q&A at the end. So as we entered 2022, there were many tailwinds and optimism for the year. 2021 had just concluded, experienced record highs for investment sales, commercial mortgage originations. As we entered 2022, the lending and sales velocity remained robust. The first quarter of 22 showed some signs that the year was on pace to beat the prior year. Sales velocities were strong, interest rates were near record lows, and property values were increasing. By the second quarter of 2022, concerns began to creep in, and a high inflation report came out in June of 2022. Interest rates rose, lending spreads began to widen, and the Treasury yield, which many of the fixed commercial mortgages are benchmarked off of, as well as SOFR for floating rate, experienced volatility and dramatic rise. The second half of 2022 was sharply different than the first quarter. Borrower sentiment shifted as investors were spooked. Fast forward to today, we are experiencing high inflation, higher interest rates, and economic uncertainty. Will the Federal Reserve stay the course? They've been managing to a 2% inflation. Will that continue to be the goal? Economic momentum has decelerated, and a recession is likely forthcoming. What that recession will look like is still being debated. What will the severity, the timing, and the duration of a recession look like? Will it be a hard or soft landing? What sort of trends and indicators are we seeing in the market? For years, we had heard that interest rates were going to increase. It never seemed to materialize, and then the COVID pandemic hit and shocked economies around the world. We saw record low interest rates. These scenarios were ones that only occurred in the most extreme stress tests. Finally, in 2022, the Fed started raising rates to head off inflation. Why was it such a shock? Did the interest rate hikes that had been anticipated and talked about for so long finally send shockwaves through the debt and equity markets as the cost of capital rose rather sharply in 22 and 23? There's a disconnect between the Federal Reserve and the market. How do you think this is going to affect the interest rates in the near term in commercial real estate as a whole? With the strong jobs report in January, the continued strong unemployment claim numbers, the unemployment rate at the lowest level in over 50 years, there are numerous companies announcing layoffs. Have we seen these layoffs come through in the numbers? Do you anticipate the employment picture to deteriorate? If so, how do you think that will impact commercial real estate? So I'm going to turn it over now to Dennis and Brian to get their thoughts on what we're seeing in the economy and how that's playing out with regards to interest rates and the debt markets.
Great, thank you. I think that there's, and appreciate the opportunity to be here today. And just for kind of transparency purposes, these are my thoughts and not necessarily those of my colleagues at the Atlanta Fed. You know, you've done a great job at articulating what we're seeing right now. We're talking, you know, we're seeing a mixed bag in there's some very positive dynamics, i.e. the jobs market. The results are stronger than the Federal Reserve has anticipated. We saw you know, very robust retail numbers the other day. At the same point this morning, you know, PPI came in at much higher month over month than had been anticipated. You know, annually it's still slowing, but I think that there is a true kind of mixed bag, and I think that's a mixed bag of results. And from that standpoint, that is very hard for businesses to make, you know, kind of consistent decisions. I think that's why we're seeing, you know, some of the signs of right sizing in as far as layoffs are concerned.
Yeah, no, I would definitely agree there with Brian, and also thank you for having me today. Very happy to share our views and how we derived our views. It's really a mixed bag, and as Brian highlighted, some of the data points are quite a contradiction to each other. Mainly last year's GDP number, I think, for Q4 was quite an upside, but mainly driven by lots of the volatile parts of the GDP components. Like, I think the core elements are really stalling. Our view with CBRE and what we use at econometric advisors to feed into our property models is we're focusing on a moderate recession. we already took the stance during the summer of 2022 that we were deviating our views from consensus. We had the view that inflation was going to be more persistent, but was peaking in 2022. We still think that inflation, of course, is high, and Monday's or Tuesday's number didn't really help pivoting that view. But we think that by the end of the year, inflation is moving somewhat towards the 4% area. What we think about the Fed funds rate is that it remains within this bandwidth of 4.5 to 5. So we might see one more hike, but those are our baseline assumptions that we have. Of course, we look at our scenarios, and I have to admit that throughout the year, our downside has become our base case in some of the quarters throughout the year as the economy deteriorated. But at the moment, persistent inflation, it's not getting a very high probability. We're really focused on our baseline, which again is a moderate recession from our views. And yeah, what that really means is we're laser focused on the job numbers. Again, I think for the Fed's liking, the jobs are still a little bit too strong, so we might see some additional hikes from the Fed. I think, Kerrianne, what you articulated in the introduction is really the story where the Fed is, and if we look at the dots of the Fed, like it's expected to be close to like in this bandwidth of 4.5, 5%. But if we look at market expectations, we really see that the markets, by means of like the futures markets, is thinking that it's deviating from the Fed's view. So both can't be right, but it would be very interesting to see where it goes.
I think you bring up an interesting point, Dennis. I mean, as far as the Fed funds futures market, I mean, you look at January's results, and in essence, over 50% of the participants had their view of the December 2023 Fed funds numbers as being the same or lower than they were in January. And so, from that standpoint, we look at the policymakers, whether it's Jim Bullard, who's kind of thrown out 5 to 7% in a presentation that he did in January, whether it's, my boss, Raphael Bostic, who's, been consistently kind of talking about 5s, along with Mary Daly and some of the other folks. I think there is, as Gary articulated, a disconnect in that there are a significant number of folks who are anticipating that rates will come down and consistent. And let me make sure that I'm clear. There are circumstances and drivers that being a data dependent firm would cause us to shift policy. At the same point, I think that that's highly unlikely because consistently the policymakers are saying, we're going to get inflation under control. It looks like some of those drivers, continue to be more robust than any of us anticipate. And, from that standpoint, I think we have to rely on that statement at that time that it's made saying, hey, we anticipate that we will have to stay the course. We will have to, potentially raise rates and keep them higher for longer to get inflation under control.
Great. I think that's a great transition now to kind of take a deeper dive into the debt space and see what sort of impact there has been on lenders and borrowers with real estate. So I just want to step back a bit and just talk about the variety of lender types that participate in the debt market. Each of these different lender types serves a particular niche within the lending market. However, the lines have blurred a bit over the last several years, with banks, for example, who typically offer shorter term recourse debt, offering some longer term debt with little or no recourse. Another example is with life companies who traditionally offered longer term fixed rate debt on stabilized properties, expanding their debt platforms to include higher yielding floating rate debt. In 2022, according to the Mortgage Bankers Association, commercial mortgage originations were down 10% in 2022 compared to the prior year. When you look at just the fourth quarter, commercial mortgage originations were down 50% in the fourth quarter of 2022 compared to the fourth quarter of 2021. These numbers were just released this week at the Mortgage Bankers Association meeting in San Diego. So just to kind of pause briefly and look at the different sources for capital, the banks take up the largest share. Their originations for 2022 were up by 22%. So they came up strong. That includes both big banks and then local community banks and regional banks. The GSEs, Freddie and Fannie, their originations were down only slightly by 4%. The life companies experienced a 19% decrease in mortgage origination volume. The CMBS experienced the most disruption, being down by 63%, and the FHA was down by 47%. So we have seen, as we've entered 2023, these different capital sources react differently to what's happening. And I'm going to turn it over. I know, Brian, you indicated you were at American Banking Association meeting this week, and I'll turn it over to you first, and Dennis, certainly jump in and maybe discuss some of your observations around these different lender sources and how 2023 may play out differently for them.
Right. Well, I mean, the event I was at was, strictly focused on community banks. And from that standpoint, we know that community banks tend to continue to originate loans longer in the cycle. From that standpoint, I think that, Dennis talked about, in their baseline assumption, a potential recession. That is, a behavior that we have kind of seen time and time again, indicative of the ending of the cycle. I think another one is, consumers using, significant amounts of credit card debt to maintain their lifestyle. But, the community banks were feeling very good about the opportunity to pick up market share, as you talked about. They're also picking up, net interest margin. And so from that standpoint, I think that they have become, somewhat of a solution for, the shutdown of CRE CLO market. In essence, they've taken some of that space. They've taken some of the market share from the larger banks. We've seen the larger banks begin to pull back as well in 2022. So I think that there is, kind of that sentiment that there is an opportunity in the CBO space to pick up market share. We do see lenders consistently telling us that their underwriting standards, they are, making them more strenuous. From that standpoint, we have accelerated our exam schedule in the commercial real estate space. So we anticipate, spending a significant amount more energy in 2023, looking at those underwriting standards, look at how the banks are perceiving risks. But we do know that there are, even though they're tightening underwriting standards, we do know that some of the performance of some of these loans are already beginning to get shaky. And in some instances, we've heard of borrowers approaching the banks to return the keys.
Right, absolutely. We're starting to see those headlines. We're seeing kind of more headlines around distressed loan sales. And as you indicated, borrowers going back and negotiating with the lender and trying to come up with a solution, with the end result being that the borrower is basically forfeiting the property to the lender. On the bank side, we've heard some of the larger banks are perhaps reducing their exposure to commercial real estate. I know with life companies, I'm just coming back from the Mortgage Bankers Association meeting and had the opportunity to talk with many of my peers in the life company space. It seems as if they have the same program size, maybe even a little bit larger for 2023 than they did for 2022. However, the challenge will be finding that deal that fits within the box, because Brian, exactly what you've described is what we're seeing on the life company side, where they've really narrowed the box and they're really focused on credit. In return, we are seeing a bit of tightening on the spreads, but in general, that's because they are really focused on very strong, high quality credit. Dennis, sorry.
Go ahead, Brian. I will chip in after that.
Okay, well, thank you. Pardon me. I think one of the risks that we're going to be facing over the next couple of years. So you think about how the market has shifted. So the non-bank lenders, hedge funds, private equity, a lot less lending from that space. Obviously, your facts are right on as far as pullback in CMBS and CRE CLO. From that standpoint, those sources in some instances have offered, we've got the data, have offered higher amounts of leverage, 70, 80, 90% leverage. We're not, as an industry, we're not at the same place today that we were in 2008, but we have different dynamics, one being that cap rates have gone lower and pushed values higher. And from that standpoint, if we have loans in the 75 or 85% LTV range, on that front, if value comes down faster or more, from that standpoint, we could have some banks that are approached by some of those sources that need additional capital, and we're beginning to prep the banks and say, hey, you're going to need to ask for additional equity. In essence, it's not going to be the cash out refi this time, it's going to be the cash in refi this time.
Right.
Yeah, I think you're making,
yeah.
No worries. I think you're making a great point that we're in such a different circumstances nowadays, just due to the fact that cap rates are that low. And if we all go back to maths and do some cap rate convexity, we'll know that small changes in very low cap rates mean very high implications for capital values. I also agree with your statements on the lender sources. Another more anecdotal story that I see is the debt funds are also being one of that, like, kind of interesting into seeing if they can increase their market share. And based on the interest and discussions that I have at econometric advisors, is that a lot of debt funds are quite interested to actually take some market share. But I also wanted to share some of the outcomes of CBRE's Lender Intention Survey, which just came out not long ago, which has quite some interesting findings in where we basically surveyed all the different lender types that we just discussed. But they're most concerned about, and we've basically discussed that, about rising interest rate, recession fears, and also uncertain valuation. And we'll get back to that point a little bit later. Also, as you already mentioned, Brian, I think their underwriting is much more conservative. They're especially focused on their cap rates and exit strategies assumptions, which I think make a lot of sense in the current environments. We've also asked them, what do they think about their origination in 2023? And more than half of the lenders that we have surveyed expect to decrease origination by more than 10%, which I think is quite telling, especially because 2022 was a year of two halves, basically, where the first half was very strong, as you also mentioned, Kerrianne, in the beginning, with record high investment volumes. But the second part was more already the price discovery era. What I also think is interesting is what do investors or lenders are still quite interested in. From the alternative space, it's life science makes top of the list on our side. And just for the core properties, it's still multifamily and industrial and logistics, which I think makes sense, especially given the supply-demand imbalances within these markets. Vacancies are still across long-term average lows that we see. So I think that the market is still like in this price discovery mode, and valuation and where are cap rates going are a very important element of their underwriting and where the market will be going over the near future.
Yeah, I think that's a really good point. Tying in the poll and the poll results that we saw, where 48% of folks on the call here felt that rates would be higher by the end of 2023. It's kind of interesting because some of the sentiment around this cautious optimism for the second half of the year is pushing borrowers to look for shorter term debt. We've seen an increase in the number of borrowers that are looking towards shorter term debt. So 5-year deals, more flexibility in the business terms. This concept of clarity of value that you're talking about, right? This price discovery, typically we would have expected to see borrowing rates pushing property cap rates higher. Investment sales fell off a cliff in the second half of last year, as obviously property owners chose not to sell into a weakening market. At the Mortgage Bankers Association meeting, Jamie Woodwell had indicated that historical spreads between cap rates and interest rates is typically 300 basis points. The difference today is about 100 basis points. And what this is doing, because the cap rates haven't increased at the same pace that the interest rates had gone up, we're seeing pressure on debt service coverage, and we're seeing thinner debt service coverage ratios on transactions, and that's leading into the lenders as well cutting leverage because they're anticipating the cap rate going up and they're building that into their underwriting. So supporting the points that you both made around that. So really, until those data points return to more historical levels, I think we're going to continue to see a disconnect with property values, and the resulting debt service coverage ratios will be thin, and that debt gap that exists, it's going to present challenges for lenders, as leverage points will need to be cut in order to maintain the minimum debt service coverage ratios. And I think as we can transition to kind of one of the other hot topics that's gotten a lot of discussion and could potentially result in some stress is kind of the challenges that maturing loans are going to face in this particular circumstances. So you mentioned it, Dennis, in terms of this debt gap, and borrowers are going to have to come to the table with more equity, resulting in cash in refinances versus what we're typically talking about, which are cash out refinances. So until we start seeing more clarity around values and borrowers' sentiment maybe adjusting to the availability of leverage on transaction, we may not see those investment sales start moving again until we get more clarity around the values. So maybe we can kind of move on now and talk about the impact. Also, I think before we do move on, the whole clarity of value, one of the other topics around that is just what is the impact of inflation on the NOIs? So not just is it the impact of the cap rate to the value, but the actual underlying NOI. So why don't I turn it over and kind of have some thoughts with regards to that?
Happy to take a first stab at this one. I think the debt gap that you mentioned, we've done quite some extensive research in the debt funding gap because we wanted to compare the current situation with what we've seen after the GFC. And the debt funding gap is nothing more than a comparison of the loan at origination, okay, how much is the amount of debt that I've taken on versus when I have to refi, how much debt is still available. And we had to make, of course, some assumptions around this by looking at only interest rates, only loans. But what we basically see is there are two elements at stake, LTVs and capital values. And when we look at the current debt funding gap, it's very much focused on the office sector. When we look at the office sector, the combined debt funding gap again that we estimated, and there are, of course, some assumptions to it, but it's roughly $53 billion, while the other sectors don't really suffer from a debt funding gap issue. Of course, there might be some situations where you get distress within these sectors, but on a average on the US, we see only real distress in the office markets. And of course, this compares quite differently to the GFC, where we saw a debt funding gap across the board. So the situation is completely different at the moment. And as you said, like, there are a couple of ways where the gap can be bridged. One of it is what I think you already mentioned around equity top-ups, which might also create some opportunities for some other private equity firms to join in with a joint venture and get some interesting, favorable deals with that. Another thing is bank write-offs, and as you mentioned, I think a REIT in New York already gave back the keys to the lender. So there's definitely going to be some distress, but the situation is completely different at the moment than what we've seen during the GFC. But we continue to update our numbers. And the second point I wanted to make is on the valuation, and it really depends the cap rates that you're using, because some suffer from this lagged issue where the actual movements you only observe quite a bit later, and some of our indices in the markets are 6 to 9 months out of date. But what we've seen from our data, and we have analysts that talk with our brokerage on the ground, is that within the office space, and this is Q4 numbers compared to the beginning of the year, we already see like 100 basis points decompression in the office sector, just above it. And that just really indicates for just average numbers for the US, while multifamily is around 70 basis point, industrial closer to 80, and retail over 80. And this just highlights that the capital value is really being hit hard within the office sector compared to the other ones. And with that, LTVs have also come down more within the office space. And that really both combined are resulting in that office debt funding gap.
And go ahead, Brian. Jump in.
Good points, Dennis. I wanted to follow up, on the short-term financing. So you think about nobody right now in our discussions with borrowers, nobody is happy or satisfied with the cost of financing. I've talked to people who have 10% construction debt, that their project is finishing, they're going to the lender, and the fixed rate financing is even more. And so they're begging the lender to keep them at 10%. So, what the strategy appears is that, to your point, they're going shorter. In this case, they're using bridge financing, 1, 2, 3 year term financing. What we know is that works well if we think interest rates are going to go down in the short term. But we know, and historical performance is not an indicator of what will happen today. But in the early 1980s, it took us a few years to get inflation under control and for rates to begin to come back down. So in essence, with the strategy of a number of borrowers where they're going short, if rates don't move down fast enough, that could accelerate challenges across the valuation spectrum. I think other thing, in regards to valuation, Dennis made some great points, but we know that utilities, property taxes, insurance, and labor are all up double digits in the last year. And if I could see all of you, I'd ask you, those of you, to put up your hands whose rents are up double digits in the last year. And kind of consistently, when I'm going from event to event to event, asking that, it's about 1 or 2% of people are putting up their hands saying that their rents are up 10%. So, from that standpoint, we've seen the bid-ask spread widen, but we know that NOI is under pressure. And from that standpoint, under pressure, more so in the likes of office, the Dennis comments, absolutely great. But at the same point, we know cap rates are also, they also appear to be headed up. And from that standpoint, we could see, changes in, percent changes in valuation with some of the sectors that have had very low cap rates impacted the most.
Yeah, and I think that's important, right? With leases, some leases may have, either flat rents or stated increases in the rents through the life of the lease, but the operating expenses could be growing at inflation, which is greater than what the rents are growing at. And all of a sudden you have deterioration in your NOI. Borrowers putting, leaning towards the shorter term debt could perhaps just create a scenario where, 3 to 5 years from now, they could be potentially maturing that debt into an even more challenging market.
One of the reasons I don't anticipate us seeing a lot of retail is maybe the one good thing that's come out of, the Amazon craze, the e-commerce, is that developers and lenders over the last decade, maybe even 15 years, have not really been willing to consistently build new product or finance it. And so from that standpoint, we've seen construction at 30 or 40% of kind of the long-term average. From that standpoint, I think retail is in a better shape, even though it is susceptible to the volatility of inflation. As we know, consumers can cut back. They can cut back discretionary spending. It is also, it's very impactful to restaurants as food prices are very volatile.
So just the point you're making on retail, I would agree with that. That's retail is probably one of the sectors that is quite favorable, and we see that in some of the discussions. And the reasons why I'm saying that is also due to the fact that other sectors, apart then from offices, are priced to perfection. Like retail cap rates are still pretty high and elevated compared to other cap rates. And if you have, as you said, within the NCS sector, that's the one we follow at EA, the neighborhood community strips, there has almost not been any new supply coming to the market, and we expect a very muted supply pipeline. And we have seen availability in that space coming down for a very long time already. So the supply demand in retail is, I think, stronger than many realize at the moment. Taking together that with the fact that it's not priced to perfection, it should be like a bit of a cushion for retail. However, if I look at the latest CMBS delinquency data, which I think on average came out about like 3%, then retail is still the highest. So with that, it's really important to look at the type of retail, very well located, just out of town. I always look at it like type of a donut for a city and where you want to be located with your retail, very well located, parking, and yeah, that type of retail I think is very appealing from a price perspective relatively to the other sectors at the moment, and it's coming back to the table at the moment in a lot of discussions.
Yeah, I think that's a really good point. Retail had gotten pretty beaten up pre-COVID. So it was already kind of facing some headwinds as we went into COVID. There was some probably resizing of loans before we kind of entered this higher interest rate environment. So, and I think it varies significantly as well, as you indicated, amongst the different types of retail. So maybe the B and C malls are still having some challenges, but there's certainly other retail sub-property types, whether it's grocery anchored or some of the strip, really well located strip, that is performing better than the overall retail numbers may indicate. It seems like office may be the new retail in terms of some of the challenges with the capital sources, willing to lend on office. It's, kind of, I think, as some of the shifts that we saw in remote and hybrid working space from COVID, the tenants are kind of shifting the space needs that they have, although there's been a fair amount of leasing that's occurring in the markets. These leases may be for shorter terms, they may be for smaller square footage. And so those are kind of contributing to some of the challenges that office is having. And then certainly the uncertainty in terms of, where cap rates are for office as well is adding to some of that uncertainty that we're seeing with office. Over the next couple of years, as we talk specifically about maturing debt, I think about 19%, according to TREP, 19% of 10.4 billion of CMBS and CLO maturing debt in 2023 is office. Approximately 50% of that maturing debt is floating rate debt. So floating rate debt typically has, extensions that are built into it. So that could help mitigate some of the risk around maturing debt. It doesn't help in terms of the fact that the interest rates have gone up so dramatically in that space, nor does it help with regards to kind of the interest rate caps that you're typically seeing on the floating rate debt. The cost of these interest rate caps has gone up dramatically from, pre-2020 when these loans were typically put on the books. So, even though there's a bit of a lifeline there with regards to they have extensions built in, those extensions may be very costly.
So with the office market, the one thing I would like to add there is that it's a very bifurcated market. You really need to approach the office in a two-tier market where you have the flight to quality, i.e. the buildings that everybody wants to be, and then you have that's part of the office market, which we basically call like commodity space, and we're working on a piece to identify the hit as hard buildings, but they're more structural. So I really feel that within the office space, you need to be really cautious, like which part you're talking about, but because there's still a part that is producing quite still good income and where the price impacts will be much more muted as the flight to quality is really a cushion for these type of buildings. But that's also quite related to what the expectations around ESG and specifically around like complying with local laws around decarbonization, like local law 97. I don't want to go into too much detail there, but long story short, the bifurcation in the office market really needs to be taken into account when examining whether a particular office building is of interest or is attractive versus not attractive.
Right, and that bifurcation, Dennis, can come in, age of construction, where, the older buildings don't have these sort of amenities that you're seeing in some of the new office projects. So whether it's the health clubs, kind of some shared space, for collaboration, suburban versus urban. A lot of the urban centers are facing significantly higher crime issues that they're challenged with. So there's been a bit of a lift for suburban office compared to some of the downtown locations that might be more challenged. So
the only thing I'd add to the comments that have already been made, I think we are seeing, a shift, and we're seeing an acceleration in functional obsolescence. We're seeing that rate of obsolescence accelerate. And from that standpoint, whether it's driven by a driver such as a consumer, a tenant issue, or it's driven by, Dennis, talked about ESG and kind of a municipal or regulatory push, I think that we will see more functional obsolescence accelerate. And from that standpoint, there will be more required investment. And that very well, I agree, it will create, bifurcations. You'll have the haves or have nots. And the question will be is do the lower class buildings do those owners have the wherewithal to make that investment to keep it up? Does, the B- building or the C-class office building, essentially, if their owner doesn't have the resources, does it become the next B and C mall?
Right.
Okay, thank you, panelists. We have some time for questions, and as to be expected, not enough time because a lot of good questions flowed in. I think the most interesting thing, if we did that poll again, I wonder what the numbers would be based upon your expertise presented. So we thank you for that in advance. But let's get to some questions, and I'll just ask them, and then I'll let the panelists please address them fairly briefly. We'll try to get a few of these in before the end of the hour. What is the role of the federal debt ceiling, its impact on the interest rates, and what signal does it send to the CRE markets if they're not going to raise it, or if they do raise it? So much signaling involved from the Fed. So could you perhaps touch on the federal debt ceiling levels?
Well, the baseline expectation is that Congress and the administration will do the right thing and raise the ceiling and keep some of the additional negotiating to another day. I think, and so the expectation is, to be very clear, the expectation is they will do the right thing. If for some reason that were to fail, I think that there would be a significant amount of uncertainty interjected into the equation. And from that standpoint, I don't think that I'm qualified to gauge how the markets will respond to that vast amount of uncertainty.
So Dennis and Kerrianne, do you expect the debt ceiling to be raised yet again?
I would go with Brian's. I believe that they'll do the right thing. And so I would expect that, yes, they would raise it.
I'm in the same park, like probably just before they'll do the right thing and raise it. It's just a lot of talks and discussions before, and well, we all know political landscape, how it works. So
okay, good, thank you. Another question: are banks preparing for defaults, or are they working about how to restructure loans? Just an overview. What do you think the focus is on, taking the default or restructuring the loan?
Right. Well, and it's a good question. We've already been faced with it. We've had a number of lenders who've been approached by the borrowers to return the keys. And interestingly enough, in the case of office space, they've refused to take the keys. So I think they are concerned about the added uncertainty that we see in the office market. And from that standpoint, they're concerned that if they take those keys back, they're taking on that liability. So they're working to restructure a number of those loans. The other thing that they're trying to do, a number of lenders are trying to get out in front of it. And we saw in 2022 that a lot of that debt that appeared to have some hair on it because there was so much capital was selling at par. And so lenders took some of that money off the table.
Yeah, and I think I would agree with you, Brian. I would think that there's going to be a greater lean, particularly in the office, to try to restructure that loan. I think regardless of the lender type, whether it's bank, life company, I think that at all levels, the lenders are certainly performing lots of stress testing on their portfolios and slicing and dicing their portfolios in different ways and making all sorts of assumptions to kind of see what might be facing in the future with regards to potential maturities coming up, stressing cap rates, and looking at different scenarios across property types.
Dennis,
yeah, I would definitely agree with our two other panelists. Like restructuring, especially in the office sector, is what I hear mostly about as well. I just hear, and this is anecdotal, in what are the expectations for interest rate? How long is this recession going to be? Can we basically pretend and extend and move over this potential wave? And given that many of us probably are expecting like either a moderate or a mild recession, I think that's why a lot of restructuring is probably the main focus at the moment. But time will tell when we see more data points coming out throughout the year. But that's my first initial take on it.
Okay, Dennis, you mentioned the R word again, recession, and you mentioned mild recession in your presentation. So I'll go around to the panelists. Are we in a recession? If we are, how would you classify it? And what's the end game here? Just a simple question for you.
Just to go first, I just wanted to reiterate, we call it a moderate recession.
Okay.
We're definitely expecting things to pick up by the end of the year, and 2024 is going to be a year of growth, although quite muted. But we expect in our baseline quite a quick recession. And for real estate, and this is, I think, where the optimism comes, and the window of opportunity is what a lot of people talk about the second half of this year. So for many, I think it's the base case. However, if inflation is more sticky, we might see the Fed becoming even more aggressive, and that will probably prolong the recession quite a bit. But again, that's not our base case.
So
I would say, go ahead, Brian.
No, go ahead. Go ahead.
I was just going to say, I'm looking forward to 2024, and I'm looking forward to having 2023 in the rearview mirror. So I think, we're still going to have some pains, and we're not quite there at the recession yet. But I think that when we do get there, it could be a little more painful than anticipated.
So, I mean, we already had two consecutive quarters of negative growth. And, it was fun to kind of see the folks who should know kind of, passing that hot potato off. I think, we have a number of projections right now. Most of them are saying, are still toward the positive side. There are a few that are on the negative side, but they're very, very moderate. I do think that it will depend on getting inflation under control, as I think that, the tragedy in Ukraine right now, I mean, wars are highly inflationary, and there are 54 countries that are supporting Ukraine in some form. And, there's a handful of countries that are supporting the other side. All of those countries are, spending dollars, pounds, et cetera, that they don't need to spend, because that, that event is just such a tragedy. I think we do have to think about, our friends in China. They have pivoted on their COVID policy. If, I take a layman's point of view and just say it took the United States a year to come out of the recession, out of the COVID kind of doldrum, and we could see China reopen in a year. And they've been heavily accommodative in their policy, which could put upward pressure on inflation. If so, then I think that the policymakers, barring any changes, have told you, their expectations, in that they anticipate getting the job done.
Yeah, and just the geopolitical risks, right, that we are seeing, China and Russia, I think it's the strained relations that we currently have could pose some challenges in 23 and 24.
You all made it very clear that we have to consider real estate by asset class, which is prudent. If we go to circle into the office sector, downtown core densification was the darling just a few years ago, but now we have a consensus that with ESG regulations possibly impacting, with the hybrid workforce, and with retrofits, and whether or not those are economical or not, what do you think the long-term prospect in terms of bank and lender underwriting for office buildings are going forward?
I would liken it to what we saw at the beginning of 2012 and 2013, when Amazon was picking up speed and e-commerce was the darling. And what did that do for retail? In a lot of instances, my lenders kind of said, hey, we see this kind of dynamic shifting. And from that standpoint, we're going to, skip a lot of retail related lending because of the concern there. And quite frankly, the pendulum swung too far. I mean, had great Class A assets with very, very strong sponsors, and they're looking at 45 or 47% LTV on a stabilized asset, and the banks, the lenders just wouldn't quote. To me, that the pendulums have swung too far. I think we will see some of that occur, unfortunately, in the office space. I do think Dennis has a very, very valid point. We are aware that activity is very strong in buildings, essentially just picking a year, but I'm close, 2010 or newer, that have been rehabbed. Those buildings seem to be garnering a significant amount of interest. And from that standpoint, I think lenders will continue to remain very optimistic in that space. At the same point, tale of two cities, everything else, excluding some property in the suburbs, probably has much, much greater challenges.
Okay, and quickly, Dennis and Kerrianne, weigh in on that.
Yeah, well, where I just want to weigh in on this one is on the ESG elements and on the retrofit. Like, I am still quite optimistic on that very good part of the office markets, as Brian mentioned it, like the 2010 and newer buildings. However, a lot of the other office buildings are located in areas that have quite good features. So what is the potential for these offices to be repurposed into, let's say, multifamily or other purposes where we have very low vacancy? And of course, there will be a cost associated with that, but it might potentially in the long run be a very interesting play. And that's where I think some of that commodity office space is going to be used for. We haven't seen it yet that much in the data, but at one point we might see it coming up. And I don't have a crystal ball, but it is definitely on my list to really follow closely.
Okay. Kerrianne?
I agree with the comments of the other panelists. I think we're going to see some bifurcation in the office sector, but office is not going away. Businesses are going to value collaboration. It's important for people to be together to mentor talent and grow the business. But I think it's really going to depend how the different office products can shift. Like Dennis is describing this commodity sort of office space. Are they somehow going to be able to add some amenities? How are they going to kind of address some of those challenges to perhaps compete? And I think that we will continue to see some challenges, and it'll be a longer drawn out sort of scenario because leases will be maturing over time. So
okay, we're just about at our end of our time, and just before I make my final closing comments, I'll turn the question around. We weren't allowed to answer the question that was posed, so I've got three experts on the panel right now, and your own question, the poll question. Just a small one. Interest rates going forward for the 2023 at least, higher, lower, about the same, no idea. Kerrianne?
I would say that they're going to be a slight increase.
Okay. Dennis?
I would say about the same till slight increase.
Brian?
If I said no idea, would that end us on a humorous occasion?
Yeah, no, I think no idea would be winning the poll right now. There does seem to be a consensus that 2023, we're still in very, very strange times, uncharted times, as it were. There's a lot of optimism trying to get through this year and into 2024, but that does remain to be seen. So, please stay tuned. We had a lot more questions, and so I'm going to encourage that we send these off to the panelists here, and we always try to follow up by getting answers out there, and this leads into a perfect opportunity to add to the scholarship of our Real Estate Issues Journal. So we're going to ask you to address the other questions as well too. And our resources for our members who are watching and our guests are without question just amazing resources. So please look at our website. So I'd like to thank Kerrianne, Brian, and Dennis for your perspective, candor, and above all your expertise and how you shared it. Let's hope that a default is averted and investors continue to place their trust in U.S. investments, including real estate. As a Canadian, let's hope that applies to Canada and the rest of the world. On-demand recordings are available for most of What Next sessions. including today's. And look for announcements on upcoming presentations this spring. We're going to be very active going forward. Until then, on behalf of the counselors of real estate, Kerrianne, Dennis, and Brian, thank you for attending this session of What's Next for Real Estate and the Life Experience. With that, lots of food to think about over the next few days. Enjoy the rest of your day, and thank you very much for joining the counselors.
Great. Thank you, Bill.
Thank you.
Thanks, Dennis.
Thank you.
Thanks, Brian.